Okay, well, good afternoon, everyone, and welcome to our session and presentation for incorporated professionals and business owners. This is an ongoing educational series that we at Rettinger and Associates are conducting, and we're quite confident that we're going to present some ideas that will be of interest to you. This is a session that is particularly timely given the large number of changes to taxation of incorporated professionals within the last couple of years. And as a result, the financial planning strategies that we have traditionally used for corporate professionals has changed, and we're hopeful that we can shed some light on some of those significant changes and the opportunities that exist as a result. So when we've done these seminars in the past for incorporated professionals, there have been some common themes and questions, including how do I go about building and creating wealth using my business or my corporation, and how do I do that in the most efficient and tax preferred way? The other question is, how do I access that wealth both prior to retirement and throughout my retirement in the most tax efficient and effective way? And then ultimately, how do I transition that wealth to the next generation as efficiently as possible? So those are three key questions that we're often asked, and I believe we'll be able to address them through this presentation today. As I mentioned, a couple of years ago, there were a number of changes introduced to the tax code, and the theory was they wanted to simplify taxation for Canadians. And in fact, what they did was almost exactly opposite. It has become very complex, and particularly for those of you who are business owners and professionals, incorporated professionals, it has become even more challenging to integrate both personal and business financial planning. So it is an area of high interest, and we're going to endeavor to cover a few topics today. Not just myself, I have Joe Murray and Adam McDonald, who are lead advisors within our practice, and they will be going into a little bit more in-depth discussion of some of the tax strategies that we employ for incorporated professionals. So we'll endeavor to understand where wealth is created for business owners, understanding the different sources of creating that wealth. We'll explore some of the benefits, both traditional benefits and new benefits of incorporation. We're going to talk about how to grow and access that wealth, both prior to retirement and throughout your retirement years. And we're going to pull all that together towards the end of the presentation with a couple case studies that will illustrate some of these concepts for you. So first, we're going to talk about the different sources of business owner wealth. As a business owner, you invest a lot of time and energy into creating an enterprise that has value. That value might be quite apparent from a business perspective, but how does it translate into creating financial prosperity for you and your family is the bigger question. So for most professionals, you're very familiar with the forms of personal wealth accumulation, things like RRSPs, tax-free savings accounts, non-registered investment accounts, and of course, real estate owned personally. What we found is for most business owners, the largest source of wealth can oftentimes be within the corporate investment environment. And there's a few reasons for that. Number one, anything that you can invest in personally, you can invest in within a corporate platform as well. And typically you will have more resources available at the corporate level than you do personally. And that's a result of taxation. We all know that, particularly here in the province of Ontario, that the highest marginal tax rate is over 53%, which means that you have less than half of your income available to invest personally if you were to draw it out of the corporation. However, if it's retained within the corporation, because active business income is taxed at a much lower rate than personal rates, you have more resources available to invest and accumulate over the long term. And again, you can invest in things like stocks, bonds, mutual funds, and real estate. And then the third form of potential wealth creation would be in the form of the value of your business or the value of your practice. Now that only has value to you personally if you can in fact sell it at some point in the future. And that's oftentimes possible for business owners who create an opco, holdco type of structure if you are able to sell the shares of your private company. Unfortunately, for a lot of professionals, that's not possible, either because there's no market for the shares. If you're say a medical professional, as an example, it's very difficult to find a willing buyer of shares. They'd much rather simply buy assets if they're available. So those are the traditional sources of wealth. And of course, the taxation of each of those different forms is different and has to be integrated with your personal financial plan. So I alluded to the fact that there were both traditional and more contemporary benefits to incorporation. In the past, things such as liability and creditor protection were of primary interest. And that's still the case for many. Those mitigating steps are sometimes limited to trade creditors as opposed to your clients. So, for example, if you're a physician or a dentist, it doesn't take away your obligation to put patient interest first. However, using a corporate structure can protect you from trade creditors. So that was a traditional benefit of incorporation. But more recently, we've used corporations to facilitate income splitting, tax deferral, and where possible, make use of the capital gains exemption. So those have changed since 2018, but many of them, such as tax deferral in particular, is still available in large measure. So I'm going to focus right now on the capital gains exemption before I hand it over to Joe to talk about income splitting and tax deferral. So as it relates to the capital gains exemption, if you are in a position to sell shares in a qualified small business, then you have access to what's called the lifetime capital gains exemption, which is north of $850,000. So a sizable amount of capital gains would be sheltered from taxation if you're able to take advantage of it. Next slide, Kirsten. And one more. So typically, if you are the owner of a company, your preference upon sale of the company would be to sell shares. But again, you're not always going to be able to find a willing buyer of those shares, so it's not always possible. But the benefits are access to the capital gains exemption for qualified small businesses, and to avoid recapture of any depreciation through the capital cost allowance that you may have taken on capital assets in the past. If you sell that asset, there is the possibility that there's going to be some recapture and taxes owed at that time. If you sell shares, you eliminate that possibility. From the purchaser's perspective, obviously their preference would be to buy assets and not shares, because of course that would limit their liability and give them a step up in their starting cost base, which means less taxation for them when they ultimately sell their interest in the business. So those are some of the reasons why the capital gains exemption and selling shares is attractive. But again, not always possible for professionals. And even for those business owners who have an opco holdco structure, depending on your province, it's not always easy to extract assets from the opco to the holdco and still qualify for the capital gains exemption. So care must be taken, and you would work with your accountant or tax professional to determine the best course of action there. Then we talk about tax deferral and income splitting, and for that I'm going to pass it along to Joe Murray.
Great, thanks, Dwayne. Yeah, like what we want to explore next are basically the recent changes in corporate taxation that have more or less required updated tax planning strategies. You know, compared to today's reality, tax planning for incorporated professionals used to be relatively simple. There were no limits on passive income, no limits on dividends to adult children, no limits on dividends to spouses or common law partners. And maybe most impactful was no small business deduction grind, which we'll get into a little bit more detail further down the slide deck. Now, these new rules have, brought clients forward to more or less ask, are there still advantages associated with incorporating? And most importantly, is there still advantages to building wealth inside the corporate umbrella? And the simple answer is yes. But what we need to do is look at what the previous incarnation of those benefits were and what the future state looks like after the 2018 changes. The first change that we want to look at are the strategies that have been impacted specifically with income splitting. And those income splitting provisions were used in a pretty considerable capacity in previous incarnations of corporate structures. And there were some loopholes that the government wanted to tie up, and they were specific to income sprinkling. Well, we need to understand, what is income sprinkling? And it's simply strategies used to shift income from high income family members, say mom or dad, to a lower income family member, say son or daughter, with the intention of reducing the combined taxes paid by the family as a whole, simply shifting money from high marginal rates to low marginal rates. Now, the Income Tax Act already contained many measures that limit the ability to split income within these related individuals, but there were still a number of opportunities to split income through a corporation, specifically by making adult family members, at least age 18, shareholders of the company. So let's look at the previous incarnation of what a family unit from a corporate perspective looked like. Now, previously, in order to meet income tax requirements, salaries paid to family members must be in line with duties that they perform and aligned with what would be paid to an unrelated person for similar equivalent work. Now, if any portion of the salary is not reasonable in relation to the work performed, that portion can be denied as an expense to the corporation, resulting in double taxation. Now we have income tax paid in the hands of the corp and then in the hands of the individual recipient. Now, prior to the 2018 budget, there were no restrictions on the amount of dividends that could be paid to a shareholder of a small business corporation as long as they reach the age of majority. So what the government wanted to eliminate was this income sprinkling to adult children, specifically between the ages of 18 and 24. Now, as we can see from the slide, typically these individuals were in school. The dividends were being used to pay for things like tuition, room and board, maybe vehicle expenses, and doing so at an incredibly low marginal tax rate. If you duplicate the lower marginal tax rate coupled with the education credits associated with going to school, basically what the government was seeing was the elimination or significant mitigation of taxes paid at the household level, and we wanted to eliminate that. So how did they go about doing it? Well, they introduced what we call TOSI, or tax on split income. And this is applied to non-salaried income paid by the corporation, typically in the form of dividends. Now, the rules don't impact the payment of salaries that are reasonable and resemble what would be paid to a third party to do the same work. So really, we're just looking at non-salaried income. Now, instead, the TOSI rules seek to limit income splitting with people who are 18 years or older, and how they come up with this calculation is far from straightforward, as is typically the case with all tax rules. Under the TOSI rules, all dividends paid to adults 18 years or older who are a related shareholder will be taxed at the top personal rate, regardless of what their individual marginal tax rate would be otherwise. These new measures also include much more rigorous and stringent testing for shareholders in that 18 to 24 age gap. They essentially require young adults to be actively engaged in the business on a regular and continuous basis, or to have contributed their own capital directly into the business. Now, we know what the rules that were put in place with the new TOSI legislation. However, there are some exceptions to these TOSI rules, which we'll explore next. The first one being the reasonable return exception and reasonable return on capital. Now, basically what we're looking for is what would be a reasonable rate of return on the capital that was contributed by the underlying shareholder, in this instance between 18 and 24. Now, if the source of the capital contributed is not from an arm's length source, such as a gift from a family member, grandparent, mom, dad, whoever, then the reasonable return must not exceed the prescribed rate of return. Currently in Canada, that's 1%. So in essence, the reasonable return would be a dividend equivalent to 1% of their capital contributed. Now, when the capital is from an arm's length source, their own capital from a job that they had, these individuals are now allowed to use the reasonable return criteria for anybody that is over the age of 25. Okay, so what are those rules? Well, a reasonable return for anybody that's over the age of 25 will be based on a comparison of contributions made by the related shareholder to the business and made by looking at a few other factors. Things like work performed in support of the business, property contributed in support of the business, risks assumed in respect of the business, and some other relevant factors. Now, in most instances, spouse and children of a professional have only paid a nominal amount for their share capital. And unlike other investments, the risks that they assume personally are generally low, if non-existent. So what this means is that in many instances, a reasonable return would be the dividend equivalent of a reasonable salary for work performed in the business by an unrelated party. So this means that income splitting benefits are modest, if non-existent. The second exception is actively engaged test, which can present a much better opportunity for income splitting, and one that we absolutely see on a more frequent basis. Where a family member is actively engaged in the business of the corporation, the TOSI will not apply, and there will be no restrictions on the amount of non-salary income that can be paid out. Now, for this exception to apply, the following facts must be satisfied. The family member must be 18 years of age. The family member must be actively engaged in the business on a regular, continuous, and substantial basis in that current year. And if it doesn't meet that current year, it can meet any 5 prior taxation years to qualify. So what does that mean? What does it mean to be actively engaged in the business? Well, this test is based on 20 hours per week of active engagement within the business. As long as this exception is satisfied, there are no further limits on the amount of non-salary income, that is dividends, that can be paid out to the family member outside of the TOSI rules. However, in this situation, there are still many professionals that their spouse and adult children will not qualify under this exception. 20 hours a week for adult children that are in university, it's going to be difficult for them to meet this exception. The third and final exception is an age-based exemption. The TOSI rules will not apply when dividends and other non-salary income is received by the professional spouse and the professional is 65 years or older. This exception will be broadly applicable and is the reason why spouses should be included as shareholders in the corporation where the legislation permits. This exclusion is designed to mimic the benefits that existing pension income splitting provisions are put in place for the average Canadian that's over age 65. If you have CPP income, old age security, RIF, or work pension income, as soon as you turn age 65, you're eligible to fully split that with your spouse. The government didn't want to penalize business owners that don't have that capacity to split with their spouse. So we know what the rules are for TOSI and income splitting, but what we want to focus on now are the changes to passive income and tax deferral strategies. This is going to have a pretty large impact on companies' ability to accumulate wealth inside the corporate structure without impacting their small business deduction limit. So on the next slide, as we see, the primary motivation for incorporating is to have access to low corporate tax rates to apply income to from an active business. Depending on what province you're in, the general tax rate for active income is anywhere from 26.5% to 31%. However, if the active business income that is earned by a Canadian-controlled private company is less than $500,000, then they're eligible for what we call the small business deduction. This gives access to a corporate tax rate that ranges anywhere from 10 to 18%. As the small business tax rate is generally much lower than the owner-manager's personal tax rate, retaining profits inside the corporation results in a tax deferral. As we can see by the example on the slide, we're going to assume a personal marginal tax rate of 50% for the owner-manager. And we're going to assume a small business corporate tax rate of 15% inside the corporation. If there's $100,000 of active business income and it isn't needed for personal use and it's not needed for business expenses, you just have this capital available to accumulate wealth, to invest. Well, option one is draw it out and pay it personally as a salary. With a 50% marginal tax rate, that means 50% will go to the CRA and you're left with $50,000 of after-tax capital to invest for your retirement. Now, in the example where you leave the $100,000 inside the corporation, pay the 15% corporate tax, we now have $85,000 of after-tax capital to invest, tax deferred, for your retirement. Therefore, we know that starting with a larger amount of capital means that there is going to be a larger amount of capital available to you to access when needed in retirement. Vis-a-vis, tax deferral still works inside the corp. Now, the government sees this, and what they wanted to do is limit how much passive income could be generated inside the corporation. More or less, stop hoarding within that corporate structure. So on the next slide, what we see is they're trying to balance how much passive income generated inside the corporation will impact basically the active business income inside the corporation. The new rules specifically tie small business deduction limit, which is $500,000 federally, with taxes, which taxes active business at a lower corporate tax rate, to the amount of passive income earned by the corporation and associated corporations, or what we call associated group, things like holding companies. Once passive income passes a $50,000 threshold, the amount of the small business deduction that can be claimed is reduced. Put simply, the new rules state that as soon as passive income exceeds a $50,000 threshold, your small business deduction will start to grind down $5 for every $1 of subsequent investment income. The small business deduction will continue to decrease until the investment income threshold of $150,000 is met. As soon as passive income exceeds $150,000, the small business deduction claim is completely eliminated. Now, keep in mind, this is eliminated for the following year, not that given tax year. Okay, so how do we develop strategies to mitigate the impact of passive income? First step is understanding what passive income is. And for the purpose of the small business grind down, there are many different sources of passive income. Now, this slide doesn't show all of them, but it shows the most common forms of passive income that we see inside corporations. Interest, net rental income, royalties, Canadian source dividends, foreign investment income, and taxable capital gains, net of taxable capital losses. Keeping in mind, CRA looks at passive income in a net form. So we're making sure that we're looking at advisory fees paid that are deductible and any carrying charges when estimating the passive income thresholds. So how do we calculate this? And on the next slide, we simply look at passive income generated in any calendar year minus a $50,000 threshold multiplied by 5. This gives us our small business deduction guide. Now, the government has developed a fancy chart that illustrates the dollar for dollar impact. And we can see this on the next slide. On the left-hand side, this is giving us our active business income inside the corporation from $50,000 to $500,000, which is what we know the top end of the small business deduction limit is. Across the top, we have passive income that is generated from $50,000, where the threshold begins, to $150,000, where we know that the small business deduction is completely ground down to 0. So if we use an example where the active business income inside a company is 300,000, and for argument's sake, they have passive income of about $90,000. Well, 90,000 minus the $50,000 threshold gives us $40,000. We need to multiply that by 5 to give us our grind. We know that that number is 200,000. So we need to take $200,000 and take that off of the $500,000 maximum small business deduction. That gives us $300,000 that's still eligible for the small business deduction. Since we have $300,000 of active business income, even though passive income exceeded that $50,000 threshold, we haven't impacted an extra dollar of income tax owed. So the additional passive income in this scenario isn't punitive. And we can see across the board where those income thresholds meet. Ultimately, the small business deduction grind results in a tax prepayment versus additional tax. And what I mean by that is by the time passive income is paid directly to the shareholder and taxes are paid by both the corporation and individual personal tax, the overall amount of tax paid is basically the same. From a tax perspective, we call that tax integration. The government doesn't want one option to be so significantly different than the other that it creates a very significant disadvantage for one strategy. For example, let's assume that my corporation has $50,000 of investment income. So that means that the next dollar of investment income will result in a loss of the small business deduction grind. If I have $100,000 of after-tax cash inside the corp from active business income, I'm ready to invest that. I'm going to say 3% guaranteed rate of return. So that's going to generate an extra $3,000 of passive income. So that extra $3,000 of passive income is going to mean a $15,000 loss in small business deduction. Ultimately, what that leads to is $2,250 of tax loss deferral. So one might ask, why don't I pay myself more salary? Why don't I give myself a deduction at the business to grind down my active business income so that I'm not penalized with the small business deduction grind? Well, let's assume that instead we pay that $100,000 out to the shareholder in the form of a taxable dividend. For argument's sake, they're going to be in the highest marginal tax rate. This will lead to $40,000 more in personal tax, assuming that we cannot draw this out through the RDTOH, which I'll discuss shortly. So if we have $60,000 of after-tax capital and a $40,000 overall tax owing, that's far more punitive than the $2,250 that we lost in tax deferral. So what we can conclude is that even though it's punitive, it's still more beneficial to continue to tax defer inside the corporation. This is mimicked with triggering capital gains inside the corporation. It doesn't make sense. It continues to make sense to continue investing inside the corp, even if there is a small grind on the small business deduction. So since we've established that paying additional income out personally doesn't make any sense, what are some of the solutions that we can actually look to limit that? On the next slide, really what we're looking at is tax planning basics. And the first one would be through shareholder loans. These are simply loans owing to shareholders that can be repaid to the shareholder tax-free. So if there's outstanding shareholder loans, then it would generally make sense to distribute that cash to the shareholder to invest personally, because you can get it out tax-free and increase the amount of after-tax capital you have to invest. Now, keep in mind, each one of these situations needs to be analyzed on its own merit, but generally speaking, shareholder loans would make sense to be paid out. Another option is through capital dividends. The capital dividend is the non-taxable portion of realized capital gains that is credited to a notional corporate tax account that we call the CDA, or the capital dividend account. Sometimes this notional account has been allowed to build, although most accountants would say a rule of thumb would be don't allow it to build up more than $10,000 to $20,000 because it can be offset by future capital losses. However, a dividend can be paid out via a promissory note if cash isn't available to take advantage of the capital dividend account if it does get too big. And the third and final option is the recovery of refundable dividend tax on hand, or the RDTOH. Although we just said don't pay taxable dividends just to avoid the grind, if the refundable portion of a corporate tax on investment income and portfolio dividends has been allowed to accumulate in the corporation, there may be no net additional tax cost to the taxpayer by flowing out a taxable dividend. And actually, there could be some net tax recovery by paying that taxable dividend out. Again, all to be reviewed by the accountant. Now, what I want to do now is pass it over to Adam to kind of discuss some of the advisory roles that can be played to limit some of the tax grind when we're accumulating assets within the corporation. A lot of what we've discussed previously are accounting measures, ledgers on a piece of paper. So some of the strategies that we want to look at are overall investment portfolio, both on the corporate side as well as the shareholders' personal investments within the context of their overall risk tolerance. Also, the implementation of life insurance as an asset class within the corporate structure, and enhanced retirement savings in the form of IPPs, which is what Adam's going to start with. So I'm going to turn it over to Adam and let him discuss some of these strategies.
Thanks, Joe. So as Joe mentioned, I'm just going to walk through some strategies available to help mitigate some of those tax implications that can arise based on different forms of incomes and strategies you may implement. So we'll just start with an IPP. What an IPP is it's an individual pension plan, if you haven't heard of it before. In its simplest form, think of an IPP like an inflated RRSP. There's more limit that you can put inside, and you also still get that tax deduction when you make those contributions. So when we talk about an IPP, it's called a pension plan because what you're doing is you're basically creating your own version of a pension plan within the corporation. So what is an IPP? Essentially, it's creating your own defined benefit pension plan. So when we talk about defined benefit pension plans, referring to things that teachers would have, police officers, healthcare workers, government employees. And what a defined benefit plan is you make contributions while you're working. The company will also make contributions. And then when you retire, there's a defined benefit. So as an example, it could be once you retire, you will receive $50,000 a year until you pass away. So it's based on your income while you're working, your years of service. But the easiest way to think of it is it's a defined amount that you're actually going to receive. So we all know those are great pension plans. One option is to create this essentially for yourself, as the shareholder will be one of the parties contributing, and then the company or the corporation will also make contributions. So there's some benefits like creditor protection, but the main thinking here is it has larger limits, so you can grow more dollars utilizing the IPP versus an RSP. So as mentioned, it provides you that annual lifetime benefit. It's adjusted based on CPI. It can also provide a survivor benefit. So similar to those defined benefit pensions, if you pass away, your spouse can still receive a benefit. And one of the big benefits of the IPP is you can take advantage of past service. So oftentimes, based on scenarios we've seen, initially setting up an IPP, you're able to put in $100,000 to $300,000 of an initial contribution and then annual contributions after that. So realistically, you're thinking about a large deduction in the here and now and then regular deductions that would exceed what you could do with an RSP. So who does it make sense for? Someone who's at least age 40. The reason that's kind of the tipping point is that's when you'll have enough past service built up, your RSP room will be exceeded by IPP limits. That's kind of the sweet spot. Also, someone earning a salary of around $150,000 or so, just based on funding requirements. There needs to be that income there to support it. So it's for someone who wants to accrue retirement resources outside of the corp. Also provides creditor protection. And another nice thing is Joe referenced passive income. It doesn't account for any passive income within the corporation. So from a company or corporation perspective, It makes sense if you have good, consistent cash flow. And the reason that's important is because there are required funding limits. There's regular administrative expenses, legal fees, accounting fees, so on and so forth. But basically what happens is an actuary will come in and say, okay, based on this person, based on this scenario, here is the minimum required funding on an annual basis. And they'll come in and regularly reevaluate it to make sure it meets the proper pension legislation and funding requirements. So this is just an example of the annual commitments that can be made of an IPP for someone starting at 40. You can see that it exceeds RSP room and then continues to increase over time. But once again, this doesn't factor in the initial lump sum contribution, which can be where a lot of the benefit comes from. So that's all well and good. We've established you can accumulate with an IPP. You're basically going to be able to put more dollars in, pay less tax in the here and now through the deductions. But once you retire, there's kind of two main options. You can treat it like that defined benefit pension in its natural nature, and you can get a regular life annuity, so a regular payout similar to a defined benefit. And that's good for someone who's just looking for that consistent retirement income. What's more commonly done is the value is commuted into a locked-in registered account. So when I say commuted, basically what it means is that regular $50,000 a year, an actuary may come in and just using arbitrary numbers, they might say, okay, based on you having received $50,000 a year, that's equivalent value of $1.5 million today. So basically what happens is that moves into a locked-in retirement account, similar to an RSP, and it just provides you with more flexibility. So same way as if you have a defined benefit pension, you can always commute that and take the lump sum amount. Yes, it's all taxable, but it's going to be a larger amount that's available, so it's more flexible. Some years you might not need that 50,000, but some years you might need more. So that's the key benefit is you're outstripping savings contributions that can be done through an RSP, but you're still able to have some flexibility through utilizing the IPP. So that was one strategy. Now we'll talk about a couple others by way of just simple asset allocation, and then also use of permanent insurance as an investment. So this is a really good example just to kind of provide you a visual of what Joe was explaining. So this is a scenario where you earned $1,000 within the corporation of investment income, and now you want to pull that out and take that $1,000 personally. So this is an integrated example of corporate tax and personal tax. You made $1,000, you want to take it out of the corporation. So what is really of significance here is these dark blue bars, because as important as is how much you make, what's more important is what you actually get to keep of that. So net of tax. So the dark blue bar is net income, what you actually receive. We can see that first bar with interest income, at least 55% of that $1,000 is going back by way of tax. So really you're only keeping about $450. You look at that compared to capital gains, which we kind of think of as growth investments. You may have heard of deferred growth. You can see you're paying about 28% in tax. So about half the tax just based on the type of income you receive. So all this says to us is, okay, we need to be very tactical in what investments we keep in what place. The reason that interest income was taxed so heavily is because it's passive income. So as we know, as Joe alluded to, it's taxed at a top rate. So there's less that you get to keep. So what we want to do is, if there's conservative investments, we don't want those in the corporation. We'd rather have growth investments in the corporation. And let's keep those conservative investments in something like an RSP as an example. It's tax sheltered. It's all going to be taxable anyways. So let's keep the safe stuff in there and have more growth in the corporation. So things like that are simple things to be aware of. It's not suggesting you have to be an aggressive investor. At the end of the day, you're going to have some conservative investments. You're going to have some growth investments. Let's just put those in the right places. Okay, so insurance is a really good option by way of wealth accumulation, but oftentimes it's a little misconstrued because there's really two types of insurance and they often get intermingled. So when we talk about your early years of life, you need life insurance, critical illness, disability insurance. Those things are in place to provide income for dependents if something were to happen, to replace and cover debt if something were to happen. Theoretically, you have more debt in earlier years. And then also things like critical illness and disability that I mentioned, they're more so there for future income protection. So if something happened, you have coverage so that things don't go awry from a financial planning perspective. So those are all, when we talk about life insurance in the early years, it's term insurance. So it's fairly cheap, gives you a large lump sum benefit if something happens. But think of it like renting. When we look towards the wealth accumulation side of things, as we transition towards retirement, that's when permanent insurance comes into play. So permanent, it's something that you essentially own. And in its most natural form, it has the insurance component, but it also has an investment component. So there's an investment that continues to grow over time based on associated premiums that you put in. And there's also a death benefit. So a cash value or investment that's accessible, and then a death benefit that is paid out upon your passing. So the nice thing about insurance is that death benefit, it's going to be paid out tax-free. And if it's paid out to the corporation, it's able to be paid out tax-free. It can also flow out of the corporation through the capital dividend account. So as I was saying, an IPP is kind of an inflated RSP. Think of permanent life insurance as an inflated TFSA. The growth is tax-free. It can be tax-free when it's paid out, but you're not limited to that $6,000 a year in regular contribution. So this is a good case study that kind of illustrates what I was saying about permanent insurance. 35-year-old doctor who's looking to put away $15,000 a year for 20 years. So what we'll look at is, let's compare a traditional investment versus this permanent policy. The investment will assume 5% rate of return. We'll assume it's all fixed income. It's all interest income, just for simplicity and to show the difference from a tax perspective versus that tax sheltered policy. So if we look at the middle column, that would be the investment. So if you put in $15,000 for 20 years, $300,000 is going to go into this policy. Then eventually you hit retirement and you want to start to draw on that investment. So 66 to 85, you're going to pull on the funds from that investment. You were able to pull out 441,000 because that investment obviously grew. You could pull out more. And then say you pass away at age 85, there's some left over, about 119,000. Once it's pulled out and all the taxes are taken care of, we're seeing about 67,000 left over to the estate. So that's just kind of the traditional investment if it was used for retirement income. If it wasn't used for retirement income, then it's just going to continue to grow, and after taxes are paid, we're looking at about 639,000 left over in that within that investment account. Now, when we look at insurance on the right column, let's assume the exact same contribution. So 300,000 went in, 15,000 over 20 years. Same amount came out in retirement years. You need the same lifestyle expenses. So 441,000 came out. The big benefit is there's also that death benefit. So 350,000 came out upon your passing by way of the death benefit, and that can flow out through the capital dividend account, and your net benefit to your estate is 350,000. So you can see a fairly material difference between 350,000 versus that 67,000. Now, what I'll point out, which kind of shows a more staggering difference, is the net estate value if the cash wasn't accessed. So there's about close to 2.3 million that would be paid out from the insurance policy. So what's the reason for that? It's all tax-free growth. There's a death benefit that was in there, and the investment value continued to grow. So that's why we're seeing such a big difference. And it might not make sense. Why is it 2.3 versus that 350? the main reason for that is in this scenario, this doctor was pulling out money for retirement income from that cash value. So when you take out money from the cash value, it's going to proportionally reduce that death benefit. So it slowly brought that down over time. If it was left, it would just stay as is. And being that this policy was started at such an early age, there would have been a fairly sizable death benefit to start. Now, one key advantage is lots of people have these policies and the intent is to use them for retirement. So how do we use them without basically reducing that death benefit? You can take the cash value and it can be used as collateral to a loan at any traditional bank. So you can use up to 90% of the cash value. So you pull on that loan gradually over time, generally at a relatively low interest rate that would be lower than the growth on the policy. And also there's going to be that death benefit component that would outstrip that. So your policy is still growing. When you pass away, the loan is paid out and the residual is paid out to beneficiaries. Okay, so let's put this all together. Let's look at what can the impact be on someone's financial plan if they incorporate, add an IPP, make portfolio adjustments, and incorporate life insurance. Okay, so Dr. Emily Chan, she's 35 years old, self-employed. Her main focus is, I want to start saving for retirement, but I want to be smart now and in the future so that I can split that income when the time comes with my spouse. Debt's already paid off. That was a priority before the accumulation phase. Currently not incorporated. Generally a moderate investor, maxing out RRSPs, TFSAs. Any residual funds are going to a non-registered account that's held personally. So first strategy that we talked about is incorporating. So if she incorporates, what she can do is she can pull out $150,000 by way of salary. And the reason that's relevant is it's going to provide her with maximum RSP room still. She'll still be able to make CPP contributions, so she can draw on that later in retirement. And the rest of those funds can just be retained within the corporation. So she can split those dividends within the corporation after age 65. So we're achieving the income splitting feature. And non-registered savings are now going to be within the corp instead of personally held. So the big benefit there, you might remember that slide Joe referenced where if you take money out personally, if it was $100,000, you could be left with $50,000, where if it stays in the corporation, that $100,000 becomes $85,000. So it's that simple concept of that larger pile of money will grow to a larger amount because we have a higher starting point, and on an annual basis, there's going to be more funds to invest because less is going by way of tax. Okay, so we incorporated. Now let's look at an IPP. So establishing an IPP, it'll eliminate future RSP room, but what's going to happen is she's going to have those inflated limits that she can utilize. And then once she hits retirement, she's going to purchase a life annuity just to create a regular income stream. So same principle as before, more dollars can be invested. It's going to grow to a larger amount. Yes, it's going to all be taxable, but because we have more growth, it lets some of those in other investments that are more tax preferred, like or non-registered investments in the corporation, TFSAs, it lets those continue to grow without having to be accessed. So more efficient in retirement, more efficient when you're transferring that wealth as well. Portfolio shift. So this is similar to what we were referencing before, having the the right investments in the right place. So she's a moderate investor because there's been the incorporation and an IPP set up, comfortable to increase that risk tolerance. So moving from 60% equity to 70% equity, that adjusts the rate of return. So obviously that's going to lead to a larger amount in the end. But one of the big things to point out here is 60-40 is kind of the traditional moderate investment allocation. That's kind of been changed over the past few years. Because we're operating in such a low interest rate environment, you're really not getting a lot on the fixed income component. So as an example, lots of pension plans like CPP have shifted from that 60-40 equity to fixed income to a 70-30 mix, knowing that there needs to be more growth and more equity within your portfolio to generate the wealth that's required. And the other big benefit here is by having more equity, we're having more of that deferred growth. So we're going to have less interest income, which we know is going to be taxed fairly punitively. So less tax in the here and now, more growth is able to be done within the corporation. Okay, and the final one would be an insurance policy. So she's going to put in $15,000 a year every year. And it's going to provide her with a starting death benefit of $825,000. The reason that's such a large initial death benefit is because we're starting this at such an early age. She's 35 years old, so there's a lot of window. And because there's a long time horizon and longevity for her, you are provided with a larger death benefit because it's going to be further down the road. So once again, the thinking here is that we can grow in a tax-free way. We can draw on it in an efficient manner. And at the end of the day, we can pull out the funds from the corporation because the corporation will be the owner and the beneficiary, once again, in a tax-free way through that capital dividend account. So what does this look like at the end? So let's just look at initial net estate, what's left over based on what she's doing. Her plan was to live within her means, same lifestyle as she does today. So with no professional corporation, just as she was doing things before, 18 million will be left over. Now that number probably seems fairly staggering, but we're talking about 60 years down the road when she's age 95. So that's the equivalent of $5.5 million today. So not that crazy of a stretch when we put it in that perspective. So 18 million is a starting point. If we allow her to incorporate, pay less tax, and have some deferral and more accumulation, we move up to 23 million. If we implement an individual pension plan, larger limits than the RRSP, 25 million. If we shift the portfolio so there's less tax today and basically more growth, once again, also within the corporation, we move to 29 million. And if we add that insurance component that allows for some tax-free growth and distribution at the end, we move upwards of 30 million. So you can see we created a 70% increase to her net estate just by implementing some of these strategies. So this isn't suggesting that everyone should do all of these things. For some people, it might not make sense to set up an IPP. For some people, because of their disposition to risk, it might not make sense to make some shifts or adjustments, but these are just some of the strategies that can be implemented, and you can see the difference at the end that's provided. One thing that people often say is when I'm gone, it doesn't matter what's left is left, but at the end of the day, most people generally would prefer that more money goes to their beneficiaries opposed to the CRA by way of income tax. So now I'll just pass it over to Dwayne to wrap up.
Thanks, Adam. Well, as you can see through both Joe and Adam's analysis, there are a number of strategies to consider to optimize a corporate structure. It is admittedly complex, but our objective is to simplify these concepts and tailor them as appropriate to our individual clients. We do that by starting with an awareness phase where we identify your current situation, just have a better understanding of what your goals and objectives are. There is no such thing as a one-size-fits-all strategy, even for corporate professionals and business owners. Depending on your individual circumstances, the strategies that we would employ would be dramatically different. So it starts with awareness. Then we help you get organized, which lowers some of the complexity and anxiety. And then with a good blueprint or plan in place, that instills confidence. And through regular monitoring and course correction over time, hopefully that achieves peace of mind. Now, in general, I'd say that our practice, we're obviously committed to our clients. The focus is on a bespoke and customized solution and plan for each one of our clients. Again, to instill confidence. We do that by regularly keeping you informed, educating you, being extremely responsive to questions and queries, and doing everything that we do with excellence. And then I would point to our team structure. As you can imagine, with all the complexity of a corporate and personal financial plan, it's important that we coordinate communications with all of your advisory team, which may include legal, accounting professionals, could be real estate professionals, mortgage professionals, etc. Our role is to help coordinate all that under the umbrella of a well thought out and intentional blueprint. And we do that in concert with, again, your extended advisory team. As far as our team is concerned, many of you probably know most of the individuals on this slide. As you know, although I'm the principal of the practice, our delivery of services goes well beyond me. We have a terrific advisory team in Joe and Adam. We have our client support group in Kirsten and Yolanda. And of course, we have our specialist team, including Gary on all things insurance, Ron regarding any securities questions or portfolio construction strategies you might be employing, and then Melanie as our mortgage and lending specialist. So it is a terrific team. I'm really proud of the team that we've been able to assemble, and we're ready to help in any of your financial concerns or challenges. If you'd like more information regarding some of these strategies or concepts, don't hesitate to reach out and ask. If you have friends, family, colleagues, or other business owners within your network who you think might benefit from this presentation, let us know. We're happy to share the recording and distribute any materials that they may be in need of. So again, thank you for spending some time with us. We hope that you found it informative, and I hope that everybody has a great day. Take care.